On Business Incorporated today, Fish Solutions says commodity prices to edge lower in 2022. An IMF Managing Director, Kristalina Georgieva, completes her first trip to Africa with a visit to Kinshasa, DRC, and describes the country's growth prospects as a bright spot. UBS retreats from South African Investment Bank's OPS. Hello, welcome to the program. I'm Ladi Williams. Well, we'll begin with market numbers from Africa, where trading sentiments were mixed between South Africa and Nigeria at intraday. Nigeria remains main index was positive at intraday, up by 0.18%, while South Africa's index dropped almost 1% at intraday. Egypt equities market closed on Thursday. Its index was up by 0.73%. Also, the Nairobi Stock Exchange ended Thursday's trading session in the green. Now to the Middle East, where major equities closed on Thursday, mostly mixed. The Abu Dhabi continued its losing streak to close at 0.79%, while Dubai's index closed positive, up by 0.92%. Still within the region, Saudi Arabia closed lower, down 0.48%, while the Qatari index gained 0.08% to close on Thursday. And rising prices have been a great concern to many consumers and businesses around the world. After years of lackluster growth and inflation, the topic has become a real hot one in the EU as well. That's a part of the conversation I'll be having with Chris Koba right now. Great to have you, Chris. Well, the bloc's biggest economy, Germany, has published fresh inflation figures for November. What does the data look like?
Inflation in Germany is as high as it hasn't been in almost 3 decades. November inflation stood at 5.2%, with the Statistics Office confirming initial estimates. A higher inflation was last recorded in June of 1992, with almost 6% back then. Germany then, of course, going through the economic excitations of reunification. Prices continue to rise after an increase of 4.5% in October and 4.1% in September. And the drivers, they remain largely the same. It's mainly the cost of energy that's to blame here, which is up by more than 22% compared to a year ago. And the price for heating oil has doubled during the same period of time. Natural gas and electricity have also become substantially more expensive. And of course, a reduction of the sales tax that was in effect last year but ended in January is also contributing to the situation in Germany. Nevertheless, rising prices are a problem to many. Economists pointing out that with wages largely unchanged or only slightly increased, many employees are facing a loss of income currently. And pressure from unions is growing for higher collective agreements to meet these higher prices.
And the European Central Bank has been, telling citizens not to worry. The hike in prices will only be temporary. Does this argument still hold up?
Well, it's difficult to say. It is true that many in Germany were pretty peeved about the ECB head, Christine Lagarde's comment that this will all blow over and people shouldn't worry. After all, for months now, inflation has been more than twice what the ECB's target is, 2%, namely. And also among experts at the ECB, the mindset is now gaining traction that these exceptionally high inflation figures will take longer to subside than policymakers thought, even just a few weeks ago. But, and that is where the argument does still hold water, inflation is largely driven by high energy prices, as we talked about earlier. Now, gas and oil prices have been way up, and stripped of those, underlying inflation is 2.6% for this year and 1.4% over a 2-year period. And that is not that far off what the ECB is aiming for. So it is a tricky situation that the central bank is in, and next week's policy meeting should therefore be a highly interesting one. According to previous plans, the Pandemic Emergency Purchase Program, which was set up to cushion the coronavirus shock and has a volume of almost 2 trillion euros, will expire in March of next year. It is likely to be readjusted and could be continued in some other way after next March. But despite high inflation currently, the ECB will not raise interest rates anytime soon. That's at least the expectation among experts.
And with the new year drawing closer, so this France's turn of holding the EU presidency, during which the French president, Emmanuel Macron, wants to set the bloc on a path to economic recovery, he says. How is this going to happen?
Well, Mr. Macron believes a new European growth model must drive innovation and job creation following the coronavirus crisis while ensuring competitiveness and adhering to climate goals. Well, that's quite a far-reaching agenda for the country, which will take over the next 6-month presidency of the Council of the European Union on January 1st. The Council is, of course, representing the 27 EU member states. Now, in order to have the necessary funding to address these and other issues, the French president has been touching, well, a very sensitive issue. He's called for the EU to rethink its budget framework and alter deficit rules. Now, under EU debt rules, government deficits should stay within 3% of gross domestic product, while debt should not rise above 60% of GDP. Now, with the pandemic and the launch of huge stimulus programs, fiscal rectitude has fallen to the wayside, and the issue is now coming back to the forefront as some member states fear ballooning public debt is posing threat to the single currency, the euro. But Emmanuel Macron wants to do away with the blanket targets in favor of considering each country's debt situation on a case-by-case basis. Berlin has for many years resisted weakening EU budget rules, but the new government here in Berlin has signaled an openness to reform, something that the International Monetary Fund only this week has also called for. Now, the French president has also said that Africa must be increasingly taken into account if the EU is to promote stability and welfare. According to Emmanuel Macron, the African continent must become able to produce its own coronavirus vaccines, while investments should be made in African youth and the region's energy sector.
All right, that's Chris Kober right there in Berlin. Thank you so much, Chris. Moving on, in the UK, data this morning showed the economy came to a near standstill in October, raising concerns that the recovery has faltered just as new restrictions are introduced to combat the Omicron variant. Let's bring in Juliana now. Tell us more. Great to have you, Juliana. Well, the data shows that GDP grew by just 0.1% in October. This shows economy has slowed to a crawl even before the Omicron COVID-19 variant was discovered in late November. How much concern does this pose right now to not just the citizens, but for the government?
Well, I think it is really concerning. And as you said, we only discovered Omicron. I think, this GDP data for the month of October is really looking through the rearview mirror. It's not exactly what's going on now. And, there were no restrictions during the month of October, but 0.1% growth is really stagnant. That's pretty much flat. Shows that the economy hasn't really gone anywhere. This follows a 0.6 growth during the month of September. I think one of the only shining lights from GDP released by the Office for National Statistics this morning was the services sector. That grew 0.6%. So finally, there's an area within the British economy that we can now say is back to pre-pandemic levels. However, because the services sector contributes so much to the British economy, you would think that we're talking about hospitality. We're not. We're talking about back-facing services. So we're talking about the financial sector. We're talking also about GPs. Lots of individuals were finally able to see their doctor for the first time in a very long time, and this contributed. But hospitality, retail, they've all fallen by about 5.4%. I think the biggest sector to worry about is construction and manufacturing in particular. We know that the global semiconductor shortage is really hampering car production and manufacturing here in the UK, and that's very much shown in the numbers. So there are concerns that what is going to happen to this all-important post-pandemic recovery, considering from Monday, millions of people will be working from home.
Quite interesting. But how are the markets reading this data at intraday?
Not great, because it's not great economically. And of course, as I've been discussing on the channel all week, we currently, the Prime Minister is currently engulfed in a political storm that's really rattling investors. Will he, won't he be kicked out of office? We'll just have to wait and see. So the FTSE All-Share is down 0.13%. The FTSE 100 is down by 0.05%, and the FTSE 250 is down by 0.39%. In the currencies market, the British pound down as well against the US dollar by 0.17%. Though up on the euro by 0.05% and up on the Japanese yen by 0.09%.
Well, as Christmas draws closer, Heathrow passenger numbers are reducing because of, so many cancellations. What picture is this painting going into next week?
Well, it's not great, is it? I think, we're just going through those numbers there. It's all the travel and leisure stocks that have been reduced. There's so much uncertainty here in the UK at the moment. Nicola Sturgeon, she is the First Minister of Scotland. She's currently giving a live broadcast now, setting out how her devolved government are going to cope with the spread of Omicron. I didn't get to hear the end of what she was saying, but there are suggestions that Scotland will be going into a much stricter lockdown than what we're seeing in England. Lots of mixed messaging about what Plan B entails, because of course the Prime Minister did ask people to continue going to their school nativity plays, to continue having Christmas parties, but did not go to the office. Is the Prime Minister going to bow under pressure and go even further, which is going to wreak absolute havoc to the already embattled airline industry? As you said, Heathrow passenger numbers are down. They were just starting to show an increase, but now people are concerned. And also, not only do the UK have restrictions, other nations across the world are starting to shut down their borders. So it's not looking great. And it is a bit of deja vu, Laddie, because it feels like we were discussing this same thing last year.
Deja vu, indeed. Well, mixed messages continue to create concerns. All right, Juliana, thank you so much. Enjoy the weekend.
Thank you.
And stock futures nudged higher today after investors pulled back from the market rebound earlier in the week and turned their focus to inflation data. Futures contracts tied to the Dow Jones Industrial Average rose 90 points. S&P 500 futures rose 0.2%, and the Nasdaq 100 futures added 0.3%. Well, the move comes after the major averages ended the regular trading session lower, each snapping a three-day win streak. Well, for more, let's hear from Maria Bird right then in the U.S.
The U.S. stock market had a rocky day on Thursday, much different than the beginning of the week, where hopes were for a strong Q4. It is clear that the S&P 500 took a dip, 0.7% down. The Dow Jones almost flatlined, just 1 point under. The Nasdaq closed at 1.71% down. The heavy tech industries had a major fall on Thursday. It is unclear whether or not inflation or the Omicron variant will have an impact in 2022, but many economists are stating that the rest of December could be a bit rocky as the U.S. tries to level out its economy.
All right, that was Maria Bird, correspondent right there in the U.S. Well, after the break, we'll look at the Africa Attractiveness report from Ernst & Young. We'll talk about that after the break. Do stay with us. Welcome back. Well, Ernst & Young, a multinational professional services network, recently released its Africa Attractiveness Report 2020. Report, which is the 11th edition and the first since 2019, viewed all the recent events and prospects for the immediate future through the lens of the COVID-19 pandemic. Well, to tell us more about this, the message in this report, we're being joined by the partner, strategy and transaction at Ernst & Young Nigeria, John Wajumogu. Great to have you, Mr. John.
Hello, thank you. A pleasure to be here with with you today, and good afternoon to
Good afternoon.
our listeners.
Great to have you. Well, your report recently released shows that Africa attractiveness this is actually the first in 2019. What does this report say about the impact of COVID-19 on African economies?
Well, the sobering reality is that the COVID-19 pandemic impacted the Africa region much more than other countries. And for Nigeria, it is really a double-edged sword because we were already struggling to drive FDI investment into our economy, but also have the volume of it reduced significantly by the COVID-19. It's had some serious adverse implications for us. And most of the reason and why Africa suffered much more than other regions, it's largely due to a lack of diversification in our economy, whether from an export standpoint or whether it's from a fiscal diversification standpoint, that is the sources from which government generates revenues, and or whether it's from a GDP diversification standpoint.
Right.
African economies are largely dependent on energy extractives, and given that COVID-19, one of the biggest impacts is mobility restriction. You can see why they had a huge impact on the Africa vis-a-vis other regions.
And your report noted that, although foreign direct investment in Africa fell by 50% in 2020, Africa is still an attractive investment destination. What is the attraction there, and what sectors are most attractive?
Well, if you look at the demographic endowment, I mean, Africa is blessed with a very large and very young population. And if you even look at the region closer to us, in terms of the West Africa region, you're talking about people of 400 million, with 200 of them in Nigeria. That's a massive market. And most of them are below the age of 35 years old. So numbers still accounts for something. And with an increasing disposable income in the population, then you can even see how the value proposition becomes increasingly more evident. So that demographic dividend, that potential for a demographic dividend that accrue from a large and youthful population continues to be an attractive element for investment. And then add to that the improvement in digital technology and the as well as Industry 4.0. And the impact it has is that it really enables a leapfrogging of the traditional obstacles that has constrained investment flow to Africa in the form of an informal and fragmented economy, and certain times infrastructure deficits. With digital technology, we're able to bring more people into the mainstream economy and therefore increasing the scale and the volume of businesses that are happening. We've seen that already happening in the fintech space. We've seen that also happening in other industries, how the digital technology is helping to unlock value. So, and it's not surprising that 4 of the 5 unicorns in Africa is coming to Nigeria, and a number of investments that are looking towards the digital space. Then another thing that is also, another sector that is also experiencing a lot of growth is trade. And that comes on the back of the Africa Free Trade Agreement, which came into force earlier on this year, which recognizes the low levels of intra-trade that happens within Africa and tries to encourage and stimulate commercial activity and making the Africa place much more attractive and stem the loss of services and goods and value that is being exported out of Africa to Europe or Asia, in terms of the goods that are being purchased that could be easily manufactured in this place. And then lastly, the infrastructure deficit that we've had. For example, Nigeria, we need $100 billion a year for the next 10 years to bridge the infrastructure gap. Therein also represents an opportunity to create, to be able to unlock value that's been stranded by the infrastructure deficit.
All right, so zooming out on the African continent now, interestingly, your report shows that East African economies grew the fastest in Africa last year. What did they do differently?
Well, to put that stat in context, it's easier to move from 1 to 2 than to 10 to 15. So they're coming from a low base, I would say. But also, but apart from that, I think that growth is a near perfect illustration of the need for a diversified economy. And that really is a simple answer. I mean, anchored by Kenya, the East Africa region has a much more diversified economy and therefore was spared the adverse effects of the mobility restrictions of the pandemic and its impact on the extractive industries, of which the West and the South, in terms of mining for the South and the West, oil and gas, is really our chief source of exports and trade. So by being diversified, they were able to strengthen the foundation of economic transformation, which is tremendously important for building resilience. So again, diversification comes to the fore and is an illustration of how important it is for African economies.
All right, so but we've seen, inequality in vaccine distribution. How does EY think this will shape, Africa's economy as we enter 2022?
So for us, while the coronavirus has, thrown many of the ills of our society into sharp relief, whether it's from slow decision making to a lack of safety net, it has also shown how far stakeholders, the community, is willing to go to help one another, and therein lays out I would say the interdependency that exists in society. So for us to resolve these inequities that we see is that it will require a level of collaboration between government and the private sector, which will require broad-based equities in vaccination rollout to stem the adverse network effects of the pandemic, because we don't, in an increasingly smaller world, we live in a global village now. It is this sort of pandemic, it's easy, it's difficult to ward yourself off. So to stem the adverse effects, network effects of the pandemic will require collaboration, whether it's government and government to government and private sector, in being able to develop a process that could create broad-based equities in vaccine distribution.
All right, Mr. John Wajamogu, Partner, Strategy and Transaction, EY Nigeria. Thank you for coming on the program today and enjoy your weekend.
Thank you very much. Glad to be here. Thank you for having me. Thank you.
All right, so moving on now. IMF Managing Director Kristalina Georgieva has just completed her first trip to Africa since the onset of the COVID-19 pandemic with a visit to Kinshasa, DRC, Wednesday and Thursday. She met with President Felix Tshisekedi to discuss the Democratic Republic of Congo's economic issues. During a press conference, she praised the DRC's growth prospects as a bright spot on the continent. Congo's economy is expected to grow 5.4% this year and 6.4% in 2022. That is faster than the IMF's forecast for sub-Saharan Africa, growth of 3.7% this year and 3.8% in 2022. Georgieva also met with newly appointed Prime Minister Jean-Michel Sama Lukonde and other officials. She concluded her visit to Kinshasa with meetings with civil society organizations and women entrepreneurs before departing to Dakar, Senegal, for the concluding leg of a visit to Africa. And research agency Fitch Solutions, Country Risk and Industry Research, expects commodity prices to ease in 2022 from current levels and forecasts that most commodity prices will average lower year on year. The research agency says that's on the back of improving supply and slowing demand. However, commodity prices will remain elevated compared with historical levels owing to a still supportive macroeconomic backdrop and low stocks. Particularly, Fitch Solutions anticipates the prices of 19 out of 27 key commodities to average lower year on year in 2022, notably iron ore, steel, natural gas, thermal coal, palm oil, and soybean. Fitch Solutions, however, expects tin, lithium, milk, and cocoa prices to average higher in the new year. Company is negative on gold from spot levels and expects prices to average lower in 2022 as the dollar strengthens and bond yields continue to recover. And UBS Group is retreating from its South African investment banking operations after laying off most of its deal makers in the country. Around 8 bankers have left the firm's office, which also covers some of sub-Saharan Africa. The bank plans to now cover its key corporate clients in the region out of London. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Enjoy the weekend.